I know there are more questions out there, but I think we need to turn the floor over to Orly so that she can do her presentation on robots, our third paper. And so I need some technological help here to get Orly on. Since she, I think, is in Texas. Okay. There she is.
Let me know if y'all are ready for me to start.
Yes, we can hear you. That's fine.
Perfect. And I was told that someone would put my PowerPoint slides on the screen since I'm having a hard time technologically here as well. Someone could just let me know when they're up.
I think they're working on that.
Okay, no problem. Perfect. There you go.
There we go.
That looks like mine. Thank you. Perfect. All right. Well, thank you for having me today. I'm sorry I can't be there in person, but thank goodness for COVID. At least I can be there virtually. I've been asked today to discuss whether we should tax robots and AI. Next slide, please. So this is a controversial issue that has been debated worldwide, and people tend to feel really strongly one way or another. Essentially, what's been happening is in recent years, as you know, we've had major advances in artificial technology, artificial intelligence, robotics, and other advanced technologies that have really impacted the labor market. For instance, we've already seen for many years, blue collar jobs have been affected, like auto assembly, customer service, grocery checkout. But now what's different is that we're also seeing robots taking over numerous other tasks that were previously reserved for white collar educated professionals. And economists warn that this is just the beginning. We are on the brink of the fourth industrial revolution, where these types of advanced technologies will disrupt the way we live, work, and interact. The question is, what should we do to address the concerns that robots may take over our jobs? Should we tax robots, as numerous policymakers suggest, or should we do something else? Today, I'm going to try to answer this difficult and controversial question. Next slide, please. I'd like to start today first by describing the international implications that result from having robots in the workforce. I'll then offer my critique of why I think robot tax is not the best solution, not the best way to address these implications. And then finally, I'll conclude with some alternative actions that nations should consider doing today in order to address the challenges of this new automation era. Next slide, please. So let's start with the implications. And if you can click the button 3 times, what you'll see on the screen are some recent headlines. If you just push the button, it'll show you, hopefully, 3 times. One more. All right, 2 is good too. So you see here some crazy and dramatic headlines that have been going on in the screen that show what the first big threat of having additional robots in the workforce is this threat of massive unemployment. Now, there are studies to support this threat of massive unemployment. For instance, there are experts that have had studies done that show that up to 30% of the hours worked globally could be automated by 2030. And many of these experts say, well, this technological revolution we need to be really worried about. It's different than the previous ones because here we have all sectors of the economy being affected, not just discrete blue collar jobs and other sectors. And then also technological progress is happening much faster than ever before. It's important to note, though, that these studies and the predicted number of jobs really vary, 1 by the study, by the expert conducting it, 2 by the industry, and 3 by the country in question. Now, there are also a lot of experts on the other side that say we don't need to be worried about technological massive unemployment. Instead, sure, robots are going to displace workers, but at the end of the day, we're going to have either no overall job loss or maybe even net job creation as robots create new jobs. And recent evidence even shows us that the most automated countries have experienced low periods of low unemployment rates in recent years. Now, when you consider that technology is rapidly advancing and what the future holds is uncertain, we can't say 100% whether or not we will have massive technological unemployment or not. What is certain, though, and what most experts agree, is that this robotics revolution will at least cause a short-term labor disruption that will cause considerable labor market turmoil, at least in the short term. So regardless of what happens, policymakers do have an important role to act now in order to mitigate some of these, to minimize this disruption and its negative effects. Next slide, please. The second big implication from an increased number of robots in the workforce is that we will likely see an increase in inequality. As we automate more tasks performed by humans, that means we have more robots competing with humans for jobs. So you have more workers, more supply than demand, which will naturally cause wages to decline. When you consider that humans are now competing with robots who don't take sick days or vacation days, are prone to less errors, this may cause a further decline in the wages of human workers. On the other end, we may have the more highly skilled, educated workers that know how to use the robotics see an increase in their wages, therefore creating this even greater income disparity. Alternatively, it's possible that the benefits of automation won't go to human workers at all, but instead will go to the owners of the robots, the owners of the capital, which is an even smaller group. And so therefore, this can cause increasing wealth concentrated in even a smaller portion of society. Again, we don't know exactly how this will play out, and it's likely that the public policies that nations have in place can help mitigate this, but this is a definite concern that the increased robots in the workforce is presenting. Next slide, please. Finally, the third big implication from increased robots in the workforce is that robots are likely to result in a sharp decline in government revenues worldwide. This is likely to occur for two reasons. Next slide. First, as robots disrupt labor markets, we're going to see more government spending trying to support their unemployed citizens. And so that's an increased strain on fiscal budgets. Then on the other end, we're going to likely see less tax revenues being generated by countries. And the reason why this is because under most tax systems, a major source of government tax revenues is borne by the workers and not by capital. This is especially true in OECD countries where social insurance taxes like payroll taxes and individual income taxes represent the two major sources of tax revenues, and a big component of those tax bases is wage or labor income. Now, this isn't to say that robots are not going to generate taxable income, just that the income generated by robots will produce a smaller amount of tax revenues than that produced by the humans that they displace. So consider the situation that results as more robots enter the workforce. Well, first, robots aren't earning wages, so there's no payroll tax to pay because they have no wages to pay that on. And without wages, they're not paying individual income tax on that labor income. Robots instead are often characterized as a type of capital asset for tax purposes, again, not wage income. And so instead it'll be treated as either generating capital gains or business profits. Each of these types of income are often subject to more favorable tax treatment than labor income. For instance, labor income is taxed on a gross basis, business income is taxed on a net basis. We often see a lot more tax preferences for capital and business income. And then also the corporate tax rate in most nations is relatively low compared to the tax imposed on the similar level of wage income. So even though automation is going to increase productivity and maybe generate additional income, that income is going to be taxed at a much lower rate. And so it's unlikely to offset the decline in tax revenues from payroll and individual income taxes. This is especially true at an international level, where the tax system often does not adequately tax cross-border income generated by intelligent robots, right, which is a type of digitalization. We already know the permanent establishment concept creates a lot of problem with business income escaping taxation in market jurisdictions. This is likely to be an even bigger issue as we see even more robots coming into the marketplace, because as robots become more advanced, they become more digital, they're less likely to take a physical form. And so therefore, there's going to be even less of a physical presence in a nation. And even where a PE is deemed to exist, a particular jurisdiction may have trouble taxing the income because of the current profit attribution and transfer pricing rules. A lot of these rules depend significantly on the location of specific people functions. If we remove the people, again, we have these issues that arise. So all of this means that the introduction of robots into the workforce can have a significant effect on the allocation of profits among jurisdictions. Of course, we have the OECD G20 framework and the two-pillar solution, which is doing important work in this area. And this is likely to also help with the taxation of robots, even though that was not the underlying focus. Now, in addition to a decrease in tax collection from payroll tax and income tax, a labor disruption is also going to reduce the amount of revenue that a government collects from consumption taxes. That's because if wages go down, people have less disposable income, which means less consumption taxes. Conversely, robots are not consumers. So any income that they do earn is not going to be subject to consumption taxes. They're not going to be consuming. So what should we do? Next slide, please. One potential solution that keeps getting attention in the media is let's just tax the robots. This idea has been proposed numerous times worldwide. Many proposals to tax the robot seek to impose additional taxes on the owner of the robot. So for instance, it would impute fictional salaries to the robots and then tax the owner, or maybe it would impose automation taxes based on the ratio of automation. So different variations of this. There's also, on the other end of the spectrum, proposals to tax the robots themselves, treat them as taxable persons for income, consumption, payroll tax purposes, and tax them in order to generate additional revenues. Now, even though these proposals vary, all of the robot tax proposals are trying to do essentially the same thing. They're trying to address the threats caused by robots disrupting the labor market. They're each generally trying to slow the pace of automation and save people's jobs, keep government revenues from shrinking drastically, and maybe using some additional of this tax revenue to support the unemployed or reduce inequality. And then in some cases, these proposals are looking to level the playing field by taxing robots comparably to their human counterparts. There hasn't really been a robot tax implemented anywhere, with the slight exception of South Korea, which isn't really a robot tax. But the calls to tax the robots are continuing to grow, and it might even continue more so in the future as we see more and more automation. Now, my argument is that even though we do need to address the threat of increased robots in the workforce, the negative implications on the labor market turmoil that they're going to create, a robot tax is not the answer. It gives rise to practical issues and negative policy implications. And at the end of the day, it really doesn't address the issues that it claims to fix. So next slide, please. One of the main concerns raised by a robot tax is that it would hinder innovation. Advances in robotics create many benefits for society, and singling out for taxation will likely increase its cost, which may disincentivize companies from investing in robotics and continuing to innovate. Never a good idea, though, to penalize technological progress. Trying to hinder automation will hurt a nation's productivity, which would negatively affect its GDP and also would likely have long-term employment growth, likely a negative impact on long-term employment growth. So a nation that adopts a robot tax may lose out on the numerous economic and social advantages that robots provide, ultimately providing more harm than good and contributing to the very problems that a robot tax seeks to address. A second big issue is the issue of international tax competition. AI and intelligent robots primarily take the form of software or other types of intangible assets, which means that they're fairly mobile. So if you have one nation imposing a robot tax, another nation not imposing the tax, or perhaps even providing incentives to invest in robotics, it's possible that businesses may relocate their robot-related activities to these other jurisdictions and give that other jurisdiction a competitive advantage in this area. This means a robot tax could cause a lot of problems if not everyone adopts it, because it could potentially drive production abroad, distort investment decisions, and then further exacerbate the loss of jobs, growing inequality, and lost tax revenues in a particular nation. Another big issue with these proposed robot taxes is that designing and implementing this type of tax creates significant practical issues and policy concerns. So as a starting point, we would need to define a robot for these purposes. But what is a robot? The question is really more complicated than it seems. Is it any type of machine that replaces a human job with automation? Does it include a bot, which is a robot programmed to perform tasks online? Does it have to be physical, or can it be something intangible like software or an algorithm that allows a computer to work as a doctor, a lawyer, an architect? Any definition that is ultimately adopted needs to be clear, predictable, and justifiable, while also flexible enough to adjust for changes in technology. Not impossible to do, but we have a very, very long way to get there. Especially because if the definition of robot is not coordinated on a global basis, implementing this type of tax now introduces an additional possibility for double taxation of the same stream of income or non-taxation. And we all know how difficult international coordination of tax rules can be. Now, even if we could define a robot, why are we doing this? Why are we taxing the income generated by this type of production input different than other types of capital assets or other production inputs? What is the justifiable basis for distinguishing between these different types of capital assets? Don't we have other types of capital assets that displace humans? Now, if the goal of a robot tax is to increase government revenues while minimizing labor market disruptions, in theory, a robot tax should encompass all technology that displaces humans, right? That imposes automation at the expense of human workers. But if robots are increasing productivity, why would we want to do that? Why do we want to discourage their use and reduce the productivity of our nation? Very problematic from a policy perspective and an economics perspective. Now, even if the above concerns can be addressed, policymakers are likely to face extreme challenges in defining and calculating the tax base subject to the robot tax. This is because a robot doesn't actually earn income and it doesn't actually pay taxes. So how do we measure the profits or value created by the robot or automation program in order to impose the tax? Many challenges arise here because it's not always clear how many workers a robot displaces. And more than that, not all automation technology displaces human workers. Sometimes a robot may complement rather than displace a human worker. Or what happens when a robot performs a job that a human has never performed before? Or if a robot enhances or creates new human jobs, how do we differentiate between these job displacing and job enhancing robots? These issues all make it extremely difficult to determine when a robot tax should be triggered and how much income should be subject to tax. It introduces a lot of arbitrariness and complexity into our already complicated tax system. Then when you take into account the global nature of our economy, each of these design and implementation issues are exacerbated. Because the term robot encompasses not only industrial robots, but really all types of AIs that can be, again, embodied in software or other types of tangible products, it becomes really difficult from a territorial sense to conceptualize which jurisdiction should tax the income. In other words, how do we determine the location of the robot when it takes on this intangible form? Under current law, it's unclear where the robot is generating value. Is it the location of the hardware, the software learning algorithm, somewhere else? What happens if the components of the robot are located in different jurisdictions? This all further complicates this determination. Also possible that the robot is not located in any jurisdiction, but rather exists in the cloud or completely online. Again, this raises sourcing issues, it creates potential abuse by increasing the mobility, and it would just create a lot of challenges for both income tax and consumption tax purposes. Finally, if robots themselves are treated as taxable purposes, we would still encounter similar issues because we would have to identify the robot's place of residence for taxation purposes. Now this type of tax, this type of tax may also be subject to the risk of tax avoidance strategies. Without international cooperation of the robot tax, inconsistent application of this tax would facilitate further tax avoidance techniques as businesses try to move these operations abroad, and also create enforcement challenges since the rules are so unclear. Also, as I've just highlighted, the robot tax proposals involve a substantial element of arbitrariness and complexity that generally translates to taxpayers not understanding their tax obligations, which increases non-compliance, whether on purpose or not, and also to enforcement difficulties. Even more complicated when you consider that these robots are usually involved in cross-border activities. All this comes up to increasing the potential of tax avoidance and ultimately undermining the effectiveness of the robot tax. So in summary, a robot tax raises a lot more problems than it solves, and it's not likely to effectively address this labor market disruption that we're worried about, rising inequality and declining tax revenues. So for these reasons, I don't believe that it is the optimal solution for addressing these issues. But what should we do? Next slide, please. So what should we do to address the job loss concerns, the revenue shortfalls, and the wealth inequality that this automation revolution is likely to contribute to? Well, even though a robot tax is not the answer, policymakers worldwide do have an important role to play in addressing these issues. There have been many proposals put out there on how countries should manage the upcoming workforce transitions. Although not perfect, each of these proposals is preferable to a robot tax that singles out robots for taxation. And ultimately, the optimal mix is going to depend really on the nation's preference regarding growth and inequality and how much disruption really the introduction of robots into the workforce contributes to. But nevertheless, there are 4 principal areas that governments should focus on as they try to address the challenges of this robotics revolution. So first, nations should strive to create an environment that fosters job creation and overall economic growth. Not surprising, right? We know that innovation and technological progress is important to the economic growth and advancement of society. So we want to support this innovation. Nations can do things like increase government funding for basic research, granting prizes to support specific innovations, reducing ineffective regulatory burdens, creating other direct financial incentives for small businesses, entrepreneurs, and other job-creating businesses and activities. All of this would minimize the impact of automation on the workforce while also putting the country in a better position to compete for and benefit from additional international investments. In the long run, investing in robots and other technologies would likely facilitate job creation in the long run, right? Short term, no, and improve overall social welfare and growth within that jurisdiction. Second thing is that countries should increase their investment in human workers. Workers, to successfully thrive in this transition period, workers need to be able to adapt to a dynamic labor market and easily transition into any available and newly created employment opportunities due to automation. This can be done through direct spending, like increasing federally funded education programs, reducing interest on student loans, other kinds of direct spending, or it can be done through the tax system, for instance, tax incentives to encourage employers to train their workers, to hire more workers. All of this can help. Nations can also do things like investing in technology that helps match displaced workers with vacant jobs. And again, numerous other proposals have been put forth. It's not likely to prevent this short-term labor market disruption, but it will help mitigate its effects and maybe increase the likelihood that workers can also participate in some of the gains produced by automation. Third, nations should strengthen their social benefit systems to help mitigate the negative impact of automation on their displaced workers. Something that's commonly suggested in this realm is the idea of universal basic income. This is very controversial, but there's also other things that countries can do. They can increase spending on unemployment benefits, implementing comprehensive minimum wage policies, providing wage insurance to encourage employment, and so forth. Finally, governments should also consider tax reforms that modernize their tax systems to fit this new automation revenue. Right? This is necessary to ensure that there's sufficient government tax revenues to fund all of these initiatives I've suggested, to make up for any tax revenue shortfalls that are likely to result from the predicted disruption of the workforce, and to minimize distortions caused by the current tax system. At a minimum, nations should ensure their tax policies do not hinder innovations in robotics, AI, or other technologies through measures like a targeted robot tax. More broadly, we need to have a global tax approach to ensure that this income generated by AI and robotics is appropriately taxed. We know that traditional international tax principles were not designed to automatically capture the shift of transactions from the physical world into the digital world, or to tax non-resident taxpayers digitally exploiting a market. There's been a lot of work in this regard, obviously, from the two-pillar solution. And this solution and any other sort of global tax approach that seeks to comprehensively tax business income rather than singling out specific types of income for taxation would really be beneficial with respect to taxing robots as well and addressing these additional issues that the introduction of robotics presents to us. And then lastly, countries should also consider re-examining their domestic tax policies in light of the changes brought to the economy by the rise in robotics. For instance, the tax laws in many countries tend to benefit capital income over labor income, but this may not necessarily always be the right result, because by doing this, we're essentially subsidizing capital relative to labor, which further increases the likelihood that businesses may prefer robots over human workers and would erode this important source of tax revenue, the labor income tax revenue that many governments worldwide rely on. So in conclusion, there's no easy answer to the difficult questions of how to minimize unemployment, improve economic equality, and raise a sufficient amount of government revenue in an equitable and efficient manner. But it is clear that a robot tax is not the answer. Any approach that policymakers take needs to embrace the robots while at the same time supporting displaced workers, minimizing inequality, and ensuring sufficient government revenues. The robots are coming, whether we're ready for it or not. And so it is in all of our interests to begin working towards global solutions so that we're able to be ready to successfully adapt and thrive in this new automation era. Next slide, please. And that is my conclusion. Thank you.
Okay, thank you very much, Orly. In the interest of time, we're running a little bit late. We're going to have a comment from Rita de la Feria at the University of Leeds. Can we get her slides up, please? There we go. There's Rita, at least. Rita, you can hear us?
I can hear you.
All right, so you're going to comment on any or all of the three papers, correct?
Yes, that's correct.
Okay, good.
Okay, shall I start or are we waiting for the slides?
You ought to start. We're trying to get your slides up, but I think you ought to start. Our time is
perfect.
Really...
Okay, so first of all, thank you very much for the invitation to be here, to be in this conference. I'm sorry I'm not in person for all sorts of reasons. I would like to go to Belgrade myself, but also because the papers that have been presented are just so interesting, and it's never the same in terms of exchanges of views being online or being in person. Also, I would like to thank the organizers for putting me on this panel. I very much enjoyed all three papers. It was a privilege to read them and to be able to comment on them. So what I'm going to do is I'll do a few general comments on what my perception of what the problem is, or what is the kind of a big picture issue at stake, and then I'll comment on the three specific papers. Shall we wait for the slides? No.
So if you want, you can upload your presentation now through the share function.
Okay, oh, perfect. Okay, can you see it?
So click on it. Click on the presentation.
I am clicking.
That's it. We go.
Can you see it now? Yes?
Yes.
Okay, I can't hear you, but yeah. Okay, I can see the presentation is now available. Okay, technology always lets you down. Okay, so in like big picture, as I mentioned, just a few general comments. The first comment is actually echoing the points that Yariv did on his presentation. The digital revolution is bringing challenges to all areas of the tax system, from tax policy to tax administration. So far, we have been concentrating on the consequences on certain areas of the tax system and not on others. So we have been concentrating primarily on corporate income taxes, loads of attention, loads of resources devoted to sorting out the problem of the digital economy to corporate income taxes. I probably controversial statement, making a controversial statement here, but with limited success. So I'm not sure that there is any viability on Pillar 1. And as regards Pillar 2, I share many of the concerns that Yariv already mentioned on his presentation. I won't dwell on that, but for me, this has been clearly a limited success. More successful has been addressing the challenges of the digital economy in the context of the VAT, has lots of less attention, a lot less resources dedicated to it, and yet it has been a quiet revolution. So a majority of countries around the world now have, in one way or another, adapted their VAT rules to digital cross-border transactions, and we broadly know how to do it in an optimal way. Now, the elephant in the room is basically personal income taxes. And so far, we have devoted very little attention to personal income taxes. And the truth is that there is very significant challenges to the personal income tax system. Now, there is also opportunities, I should say. I won't dwell on those now, but there are also opportunities that the digital revolution presents to personal income tax systems. But as I can see, there is two main challenges. All of them were the focus of the presentations in our panel now. The first is the automation challenge, which Orly discussed. The second is the mobility challenge, which Yariv and Peter mentioned. Now, if you look at the mobility problem, the mobility of individuals was not only predictable, but it was actually predicted. So we have had studies spanning back about 15 to 20 years mentioning that this was about to happen and the challenges that this would bring to labor markets and to the way we organize society. Now, they weren't necessarily focused on taxation issues, but there were a significant amount of people, primarily in the area that is broadly known as futurology studies, looking into this and saying that there are very serious challenges coming down the tracks. Now, if we look pre-pandemic, interjurisdictional working was already happening, and the living and working in different countries was already happening, but it was limited broadly to a small part of the population. So the ultra-rich, very high-end scientists and so on. What we have seen post-pandemic is the dramatic acceleration of this process of dissociation. So it is true that we had it, and the brain drain mentioned being probably like an early stage version of this type of situations, but albeit that you were living and working in the same place, but you were coming from another country, the problem that Yariv mentioned. But the issue of this dissociation between the two elements of work and residence has dramatically increased with the pandemic. Now, the automation problem, as Orly mentioned, is basically a problem that is coming down the tracks from two sides. So first of all, the revenue is going to suffer because there will be labor displacement effects, and it's going to be felt heterogeneously, as she mentioned, Different countries will feel it differently. Different industries will feel it differently. So it's not the same level of effect across the board, but we can be pretty confident now that there is going to be an effect. And on the other hand, you're going to need extra expenditure because you need to reskill the workforce. Now, the consensus from economists and a kind of medium to long-term perspective is that these will be broadly welfare enhancing because they will increase productivity. And also, they will deal with some challenges, societal challenges we have down the line, for example, population aging. In the short term, however, as she mentioned, there will be very significant disruption on the labor markets, and the problem is that these will going to be felt very quickly. So the problem is not so much that technology changes are bringing labor and societal consequences, but it's the speed on which this is happening. Now, why does these problems matter? Because, first of all, rich countries and EU member states are prime an example of this, rely heavily on personal income taxes. So taxes that, and when I say personal income taxes, I'm saying lato sensu. So personal income taxes to include not only the personal income tax, but also social security contributions. So are a very significant part of the revenue. And if you have any changes to revenue on these taxes, it's going to have an immediate impact on the levels of revenue that are going to be gathered. So Georgia Maffini and I have a paper on this. We looked at UK data to make educated guesses on the amount of revenue losses, and that the results were surprising even to the two of us. So if you have even a minimal mobility at the top of the income distribution, which is the individuals at the top of the income distribution are likely to be the ones that are more mobile, the revenues immediately come down dramatically. And this is because our systems are progressive. So if you have any shakeup at the top, the people who pay more taxes, then it's going to be felt immediately. So in the UK, 140,000 people moving, which is literally nothing for a country of 60 million people, immediately brings a loss of revenue of £6 billion annually. So any small change is going to have a big impact on revenue. The other reason why it worries me personally, and maybe not everyone is on the same page as me on this, is that personal income taxes are our best instrument to achieve equity in tax systems. So if you have any shakeup, any issues with automation, with mobility, in personal income taxes, you are going to have problems achieving a fair tax system because basically this is our best instrument. So other taxes that we have fulfill other functions. Equity in our tax systems tends to be primarily fulfilled by personal income taxes. Now, how do we address these problems? We had 3 papers today, and 2 on the mobility problem and 1 on the automations problem. So starting with the mobility problem, Yariv spoke about the brain drain and the dissociation of physicality and residence. I think the key issue for me here, and it would be much nicer to be discussing this in person, but a key issue for me really is the benefits. Now, if you look at a kind of historical perspective, you can think, okay, you were educated in a specific country, then you moved to another country, you benefited from that country, education, etc. But you can see it also from a present day perspective. So you have kids, your kids go to school, you get sick, you go to hospital, you use the roads, you use the police services, etc. So to what extent is there a legitimacy to tax in other countries other than the country where you reside? So I think the issue really will not be so much one of absolute benefits and absolute legitimacy, as the word he used, but I think the key issue is a hierarchy of legitimacy. So who is more entitled to receive revenues from these workers? I also have significant concerns about citizenship taxation, partially for the reasons I just mentioned of the benefits, but partially for one that probably Yariv is not necessarily concentrating on, but for me as a European citizen worries me significantly, which is a retreat to kind of national taxation within European circles. So I often say that that in my hierarchy of priorities, I'm first a European citizen, and then I'm a tax person. If I had to choose between the two, I would prefer to have a system of integration within the EU where nationality doesn't make a difference, and we're all European citizens and all subject to common rules, than a situation where, you know, because we can't agree on this specific who is more legitimate than the other, we end up in a situation where citizenship of a specific European country matters for the level of taxation that you will get.
Rita, I have to interrupt you for a second because we are very limited on time. So we're
okay.
only...
So I'll go quickly then. So in terms of Peter's presentation, I think the key issue is competition, and the fact that preferential tax regimes are emerging is an early sign, in my view, of competition. I think that this is very concerning. There is commonalities with corporate tax competition, and it didn't go well there, so I don't think it will go well as regards personal income taxes. As regards Orly's paper and automation, I agree with her that robotax are not the answer. I think the key issue here is that we don't often see the difference between aim and instrument. So the fact that we frame the problem as a problem when personal income taxes revenue loss means that we're trying to find a solution as a clear substitute, and I think that that's not the way forward. Finally, I'll just say this. I think the magnitude of the problem is quite big. I am fearful of the societal consequences and the economic consequences of these challenges, and I think we need to refocus our attention into personal income taxes and away from corporate income taxes. Early action and coordination, in my view, will limit the potential damage. Thank you.
Thank you. Thank you, Rita. So sorry to hurt you through that.
It's okay. I don't know how to stop sharing the screen, but
So we now break.
Just to provide.
Good afternoon. I'm Dejan Popovic, Professor Emeritus at the University of Belgrade Faculty of Law and President of Serbian Fiscal Society, the national branch of FIFA. On behalf of Serbian Fiscal Society, I wish you to enjoy your stay in my birthplace, Belgrade, and in the event you are already attending. I take this opportunity to greet my co-chair of this panel, Professor Joachim English from the University of Münster, who is with us online. I hope that everything is functioning well. We have 4 topics to be presented and discussed during this session. Each of the rapporteurs will have 15 minutes to present his or her paper. And then, after each presentation, we shall invite our panelists to comment on the issues raised by the rapporteurs. We changed slightly the way how we will present our rapporteurs. So we will start with Dick Molenaar, coming from Rotterdam, where he is a partner with All Arts Tax Advisors. He also has strong academic links with the Erasmus University in Rotterdam. Dick Molenaar's topic is how should we tax income on online influencers? The floor is yours.
Thanks, Professor, for the for the introduction and for the invitation to come into Belgrade. I had the chance to see the city yesterday because I was here already then, and yeah, I find it very interesting. So I'm happy to be here, and it's an interesting conference, and it was very nice to write the chapter for the book about the subject where you asked me for, taxing the income of influencers. First, the introduction to the subject, although I presume that all of you know what influencers are, of course. Well, to start with, let's say, I would say it started with mainly with YouTube. initially, also with Twitter first, Facebook, but it really got bigger with Instagram. And the idea behind it, especially with YouTube and Twitter and such, is that those social media platforms gave us, let's say, normal people a way to express freely what we are experiencing, what we are doing, what we like, what we don't like. Well, very often it's quite positive what you put on a social media platform, like what I did yesterday on Facebook with that. I was walking through the city here. I saw a group of musicians playing. I made a photo. I put it on Instagram and Facebook. I got 100 reactions because I was showing that I was happy that I experienced it. So it's very often positive. And it also gives us the availability, the possibility to listen to what others are experiencing. So the 100 reactions, though those people were happy that they saw me experiencing it. But not so strange. After some time, it seemed that some voices were louder than others. Some people have more to say, have more experiences, or make more out of it. And that were already started with YouTube, and I would say that especially with Instagram, it really accelerated. It also gave the opportunity to connect with commercial activities. So it also, when on social media platforms, same as in newspapers and on television and radio, people are active. It also gives the opportunity to connect with services and goods which can be presented, can be supported, and of course in a different way from a normal classic advertisement, and very often a sort of very informal and not clear that it's really advertisement, and like that those products or services are really supported. On the other hand, the influencers have become a sort of the new stars of this time. I'm not going to say that sports and regular entertainment, like I spoke yesterday evening with someone who went to see Ed Sheeran the other day in Switzerland, and I'm not going to say that those are not the stars anymore, but there is a new type of stars has arisen, and those are the influencers which are very much followed on social media platforms. And I named a few. I mean, very often it's sports persons like Ronaldo, or it's entertainers who are very popular also as influencers, but there are also those who don't do any sport at all. And what is also very interesting is that there are, and that's I didn't add it, I already wrote it before, but it's in addition to the presentation before lunch about robots, there are also virtual influencers. They look like real people. We have one in Rotterdam where I come from, Esther Olofsson. She really looks very normal. It's also saying that she's coming from Sweden. She likes Rotterdam. She goes everywhere, but it is not a real person. It's a virtual person, and it's an influencer because she also presents products and services and such. Well, there has been I don't know by head where I have it from, but the size of the market of this influence and commercial is around 13 billion euros a year this year, is what they estimate. So it's getting very interesting. But of course, we are here for the tax aspects, and therefore I've listed the articles from what I would say the OECD model or the UN model or any bilateral treaty that could be linked to this type of activity and to the income coming from it. Of course, Article 17 might be Article 12 or Article 15 when it's employment income, but the very special Article 17 as an exception to all those other rules, I would say it's best to check this first, because if the income of the influencers would fall under Article 17, the other articles would be set aside. So I prefer to discuss the exception first, because otherwise we're going to talk about the other articles and that wouldn't make sense. The commentary on Article 17 does not give a definition for an entertainment or sports person, but gives some examples. And I would say that that an influencer starting or using his or her personal life and experiences and such, what he or she is doing is very much entertainment, is very much showing to others, either scripted, either really written out before and directed, uh, or perhaps very spontaneous, might also be, but that's not different from other types of entertainment, from film actors or from stage actors or musicians or such. That might also be very much scripted and can also be very spontaneous, like in jazz music. And the commentary also speaks about mixed activities. So it also speaks about making advertisement, but is saying then it should be really clear advertisement. And the entertainment character should be very small. And I would say with influencers, they still bring it as their normal life, and the advertisement comes a sort of with it. It's not like normal advertisement. And there are also examples and a description about sports persons in the commentary, but I don't think you can say that influencers can be seen as sports persons. So when a football player like Ronaldo is putting all sorts of posts on Instagram or Facebook, then he doesn't do it as a he's not playing football at that moment. Of course, sometimes he does, but we are not playing football, but he's more an entertainer then, and that's under the commentary also possible. My conclusion from this is that influencers most of the time, or let's say in more than 90% of the cases, can be seen as entertainers, and therefore their income should fall under Article 17. Well, then about Article 17, well, you will know that you might know that it started already. It was already inserted in the draft model of 1963. In 1977, the second paragraph was added to avoid that payments to others would be out of the scope of Article 17. And there was quite a dramatic report in 1987 showing that the article is in the model because entertainers and sports persons cannot be trusted. They try to go around taxation, move in low tax jurisdictions, do not declare their foreign income in their residence tax returns and such. So it is an anti-avoidance measure. And what also came in 1987 is that so when countries take this over in their tax treaties and of course in the national legislation, it might be hard to calculate what the taxable income would be, because normally, as we heard already in the morning, tax is raised on the profit, not on the turnover, but on the profit. And but with entertainers and sports persons going around to various places, it might be hard to determine the profit, and therefore the OECD, not really recommended, but gave also the option in the commentary to not tax the net, not tax the profit, but tax the gross income, but then at a lower rate. What we already heard in the morning about the UN model and about developing countries. But there are quite some problems with Article 17. With this taxation in every country that you go for your golf tournaments or for your DJ shows or Coldplay touring around the world, there are quite some problems because the tax credit method is recommended by the OECD. Some countries have the tax credit method in any situation, but European countries very often have the exemption method, and there is more proof needed for the credit method. You need to have the information about the foreign income, and that needs to be accepted by the tax administration. So I also wrote down that it might be that you cannot get a tax certificate. You've been to another country, you perform there, taxes be taken off, but they do not give you a tax certificate, or it is in the wrong name, the name of the agent or the management, or or it is in a language that you don't know, and the tax administration says, first take an explanation from me. And but what very often is happening is that excessive taxation happens, and that is actually because of this sort of recommendation by the OECD to tax the gross income instead of the profit at a lower rate, but mainly countries do between 10 and 30% tax on the gross income. That's the practice. Then, of course, the taxable base in the residence country will be much lower because all expenses need to be deducted, like your agency fee or your management commission or your assistance, or like with Coldplay, the 20 trucks that you have with you to go around. All those expenses need to be deducted, and therefore the taxable base is much lower than it had been in the country where you have been performing. So it very easily happens that the foreign tax is higher than the national tax, and especially when there is a limited company in between, and only the limited company gets the credit, while the personal on the personal income and the personal tax of the entertainer or the sports person, the credit is not allowed. So excessive taxation easily happens, and especially for small earners. It's also the case when the income is low that with personal allowances and such, there is no or just small income tax to be paid, and then they are easily overtaxed. There has been a discussion at the OECD to remove Article 17. There are a few authors who already wrote about it, and there was a public consultation, and there was a proposal. Together with Mario Tenore and Richard Van, we wrote an article about it. Should Article 70 get the red card? So there was a discussion within the OECD, but in 2014, the OECD has decided to keep Article 70 for entertainers and sports persons. And the OECD gave 3 reasons, which are still in place. One is the resident states have difficulties with obtaining information about the foreign income. Albert Rita already spoke about it this morning in the European context, that it can also be the case. Second is still the old reason that top stars are moving to Monaco or to Dubai or to Andorra or to places where there is no income taxation or just low tax. And the third is that source taxation can be administered relatively easily. Well, you've already read it. I believe that those 3 reasons are wrong. First, payments for performances, for sports events are nowadays always going via the bank. So it's not a cash world anymore as it as it was in the 80s or in the 60s. So that has really changed. Or what would also be possible, and what Dr. Harold Grams wrote about in the year 99, you could introduce an exemption procedure before the income could be exempted in the source state, so that the tax administrations at both sides know about the income. So I would say those difficulties can be overcome. Second, and that's a main thing, is that Article 17 in a tax treaty doesn't prevent influencers, YouTubers, pop musicians, Formula One drivers like Max Verstappen. It doesn't prevent them from going to Monaco or Andorra to go and live there, because a tax treaty provision is not relevant when you move to a tax haven, because the tax havens don't have tax treaties. So you don't have to put an Article 17 in a treaty to prevent them from going to Monaco. They go there because there is no income taxation, and they accept the source withholding tax, which will not be taken away. It would be much better not to have an article like Article 17, because then those top stars would stay in their own country because they would be prevented from those foreign source tax. So the second reason from the OECD is actually quite simple. They don't understand how it works, which is. And third, and that's what we heard in the morning several times. A source taxation is not easy because you have to declare your income in 2 or more countries. I'm working for DJs who have been performing in 30 countries in a year, so they have income from 30. It's not easy. It's more complicated. It's much simpler. It's a risk of double taxation, and especially as Albert Redler from the European Commission was saying, it's causing extra administrative expenses. Not officially, but in talks over the years, it had also been said also in 2014 when the OECD decided to keep Article 17. I heard from people in Germany and France, we want to keep it because of the tax earnings. We cannot let the Rolling Stones go out of the country and they not have paid tax, you know. But this is sort of fable. This is not a realistic argument. There have been figures from the government, from the tax authorities in Belgium over the years 2014, 2018. They have an 18% withholding tax there. You can file applications to deduct your expenses. And the tax earnings from both entertainers and sports persons are between 17 and 21 million euros a year. So it's not that much. I mean, if you would extrapolate that to the UK and the US, it can become, let's say, a billion euros in the US, but still, it's not that much. And on the other side, as I explained already in my question this morning, as a country, you can collect this tax, but you also have to give tax credits for your residents who have performed abroad. So like for the UK, they can collect that 20%, or perhaps from April next year, their 90% tax from those sports persons playing the British Open golf or the big stars going to Glastonbury to perform there. They can take that 20 or 90%, but they also have to allow to Coldplay living in the UK a credit for the tax that they have been paying abroad. So I think that the balance is nil in the end, and it's not bringing anything, but only causing administrative expenses. Well, back to the influences. As entertainers, as we experience them as entertainers, quite an issue is, of course, I've made an example, quite an issue is that it might be that they receive their income from another state than where they are performing, where they are acting, where they do their work. So like a Danish influencer sponsored by a UK fashion brand, by Nike, for instance, going to Spain, shopping there, going to Atletico Madrid and to show off with the football players who are also sponsored by Nike. I mean, that's a realistic influencer activity. But how is that done? Is Spain going to tax the income? Is Spain, because there is no money stream from Spain to Denmark. There's a money stream from the UK to Denmark. That was also discussed this morning. How is that? Is that Article 21 then? But then under the UN model, you need to have a special clause in Article 21 to do it. And is Spain strong enough to apportion it partly to Spain, like the UK has done in the case of Andre Agassi, the tennis player, who had been playing at Wimbledon and won. Well, in the end, he reached the quarterfinal or such, and he filed a tax return and he wanted to reclaim a part of the withholding tax. And then the UK tax authority said, yeah, you're also sponsored by Nike and by Head for your tennis rackets. So we want a part of your sponsorship income being taxed in the UK. Such an apportionment. I mean, the UK managed to do that, and the High Court accepted it. And in the US, with Retief Goosen from South Africa and Sergio Garcia, the two golf players, the US also managed to do that. But other countries are not strong enough, are not developed enough to find this. And especially for influencers, this is complicated. Another issue is, of course, deduction of expenses. If Spain taxes it, can the influencer tax her expenses? And how about the tax credit in Denmark? That brings me to Perhaps a strange connection, but a connection to Pillar 1 and perhaps even Pillar 2 and Article 12b of the UN model, because this Article 17 for entertainers and sports persons is not based on a permanent establishment. It is a matter of activity there. Coldplay is not having permanent establishment in all those countries where they are performing, and still they are taxed there. That's, let's say, the same principle as Pillar 1 has, and also as Article 12b has. Interesting for Pillar 1 is that already has been recognized quite early that you should set quite a threshold to take out the smaller and medium-sized companies for whom it would be too much administrative work to organize everything. And otherwise also the tax administration would be overwhelmed with, tax administrations in 2 countries would be overwhelmed with it. And interesting is that the tax administrations are cooperating there, which under Article 17 would also like to have, that we don't have to chase the tax certificates ourselves, but that the information is exchanged to other countries.
Your time is expiring, please.
Yeah. So that could be examples for Article 17. So my conclusions: influencers are entertainers most of the time, perhaps not everyone, and they fall under Article 17, which means taxation in the work states and no permanent establishment required. But it's interesting how to apportion the income then to the work state. I would say it doesn't work for virtual influencers, which is a connection to the discussion about robots, but that the company who created the virtual influencers, who is exploiting the virtual influencers, just pay tax on it. Yeah, Article 70 perhaps can better be removed, but we're going to have a discussion in the next session, not after this. And interesting is, of course, the comparison with Pillar 1 and 2 and 12b. Thank you.
Yes, it was an excellent observation by Dick Molinar on the fact that in the new environment, once the Pillar 1 and Pillar 2 are implemented, just a smaller fraction of income would remain to be taxed in the state of source, given new formula for allocation of taxing rights under Pillar 1. But let us now hear the observations of our panelists. To remind you, our panelists are Dr. Marcel Jung, partner with MLL Legal Switzerland, and Ignacio Gordillo, Ceca Megan Abogados, Spain.
Thank you. Many thanks for the presentation. I have just a small comment. I believe that the problems or the difficulty in application of Article 17 comes from the court decision in the UK and the US, where there was a very extensive interpretation of the rules. And if I look from my country, Switzerland has entered an observation in the commentary to Article 17, according to which advertising and sponsoring income is not in scope of Article 17. And Switzerland does also not apply such income because it's not directly derived in connection with the physical performance. And this is also upheld by the Swiss Supreme Court. So my proposal would be, instead of the abolishment of Article 17, to reduce the scope of Article 17 to the important issue. This is the income stream which is really directly generated by the physical performance of an artist or sports person in a source state. And I think it cannot be really compared with Pillar 1 and 2, because a sports person is physically present in the source state. This is the principle of Article 14. And the difference is a sports person is 1 day in a source state. There's no need for a 183 rules like a worker. And therefore, in my view, still, I think it's really reasonable to have Article 17 in the OSD model.
have someone else in you.
Yeah. Let's start with you. Okay. The microphone is no. We start with the gentleman in the first row, please.
Thank you, Dick, for the very interesting presentation. I agree actually that Article 17 should be kicked out from, from the model, from my perspective at least. But I do not really have a question, more a comment, a general comment, which I saw researching, you may know that I am a VAT specialist, but I also deal with individual taxation. And I always, perceive that there is an incumbent issue every time. And the issue is about characterization. So we stick to legal categories, and in our field, tax categories, or in my field, VAT categories, that basically no longer hold. So I wonder whether we should actually restructure our, system based on new categories. For instance, I did that with, I proposed that when I analyzed in a paper that was published this year, last academic year, in International Tax Studies about, the definition, the distinction between self-employment and employee. So what is the distinction with the Uberization of everything? So it's no longer, easy to define. We have the same issue with VAT categories. For instance, for place of supply, we define different supply based on what is their nature. The problem is, what is their nature when we have digitalization? So I really think that also you point out basically to the same, and even in a more prominent way with regard to entertainers, on the one hand, and artists. So what is an entertainer? What is an artist? I mean, it's difficult to define when it becomes so easy to become an artist, just, showing up with a video, on a YouTube. So I think I'm not sure whether we should perhaps redefine our categories, our way to think about tax in general and law in general. So it was more a comment, but I essentially agree that we should redefine Article 17.
Yeah, the gentleman in the fourth row.
Thank you.
You're
Thank
in
you.
the second, but okay.
Okay.
Okay, he was really insistent at the beginning, so please give
Andres,
him in the fourth,
okay.
and then you will get your.
Okay. Thank you. No, I'm first of all, thanks for the brilliant presentation. I have a couple of points. I don't think the problem is Article 17 itself. I'm in favor of maintaining Article 17. I agree with what Marcel said. But I think the problem is the lack of clarity of the commentary. And I think the example of the influencer is really illustrative in this respect, because the commentary mentions some persons that would meet, let's say, the criteria to be considered entertaining, but I think it makes confusion. For example, there is a reference in the commentary, which I've never properly understood, to a film actor who is performing in a television commercial, which I think is to some extent a contradictory concept, because an actor who is performing in a film is supposed to entertain. An actor who is performing in a television commercial, I'm not sure is there primarily to entertain. And I think the issue for influencers is really whether they are entertaining or they are there because they are to convince me to buy a shirt or the last pair of shoes, so to say. And then,
like your first example is, for instance, George Clooney with Nespresso. Television commercial, George Clooney with Nespresso. It's very clear he is an actor, you know. He's also acting. He's doing the same way. It might also be that it's natural, that it's his natural way of doing. But it's very clear that he's advertising. You know, that's the main purpose. And an actor really advertising. But the difference with influencers is when you watch it, you still have the feeling that they do their own show, that they're doing their own activity. And in the meantime, they're coming up with Nespresso cups, you know, because they say, yeah, I'm at home, I'm having a good time, I take a coffee, and then there comes this Nespresso and it's put in. So it's not primarily advertisement, for them, but for those who are watching it, it's still the entertainment.
Yeah, and but that's a good. But let's say then it becomes very subjective. What is entertaining and what is not. Last point, responding to Marcel, I think it's not really the problem with UK and US courts. I think the commentary has been, I must say, in this respect, clarified with the 2017 amendment. So the golden rule or the rule of thumb is whether the person, the sports person or the artist would have received the remuneration from the sponsor without the performance. If the answer is yes, then the commentary says it's Article 17. Income is closely connected to the performance. I think that's a clear guidance and very helpful in practice as well.
Let us forward the microphone to the gentleman in the fifth row, please.
Thank you. Well, this is a question I had in my office in the university. It's an academic question originally, but I later saw that was also an issue in the practice. You know that 8 out of the 10 best paid YouTubers, Spanish YouTubers, are residents in Andorra. The tax authorities told them, well, be careful. We will be watching you. You might still be resident in Spain, but apart from that, in as much as all your viewers, which is not true because many viewers are in the US and Latin America, but most of your viewers are in Spain, we still can tax you on as non-residents. And my question here is very much in line with the question of Giorgio Beretta, also very much in line with the question of Mario, because I think that the way these people do money is totally exploiting our traditional categories of source taxation, because we shouldn't forget it. These people do money with advertising. That's the big money here. Google AdSense and private marketing affiliation. So YouTube is paying you per viewers or per views, and local sponsors are paying you per views or per links press. What is that? Is that a service? Or is that a royalty? Because if you see the contract with YouTube, there is a universal license of the content, not exclusive. It's said in the contract. It's not exclusive, but still a license. So are we talking about a royalty here? And of course, this might be crucial depending on the domestic sourcing rules and depending also on the treaties. And my question is whether you can give us some indication on this qualification.
Mr. Molinar would answer.
Very short.
Yes.
I would say you don't need Article 17 for this, because they decided to move to Andorra. You know, let Spain and the other countries keep their source tax, their withholding tax, and because there is no treaty, there is no tax treaty, don't exempt the source or withholding tax. Just tax it. You know. Yeah, but I mean, if all the countries have their source withholding taxes and say we only exempt it when you show us a treaty article and you show your residence, and then we accept an exemption, then it's fine, because then they are taxed in Spain for what they get from it, even when they're living in Andorra.
Since we have 3 more rapporteurs and their discussants, I will allow just one more question, and it's to you, gentlemen.
No. Okay, is it better now? Sorry. I had always thought the reason for Article 17 was that these people could earn a very large amount of money in a very short period of time. That's what I always assumed was the basis of Article 17.
And
However,
why would that be a reason?
well,
Because there are also
it,
others who are earning a lot of money
well,
in a
that's
short
where I'm
period of time.
going. I've never understood Article 17, why we as tax people should have to decide who is and is not an entertainer. That's a crazy question. That's not a tax question. I mean, a tax question would be: is somebody earning an exceptional amount of money in a short period of time? I would also add, on the other end, Article 17, by talking about entertainers, I mean, why is the source country concerned about the bassoon player in the Berlin Philharmonic, for example? I mean, it seems to me that the provision is wrong on both ends. It doesn't cover enough people if the concern is people making a lot of money in a short period of time, and it covers too many people if it covers the average person in an orchestra. It's just not a coherent provision.
I would say we have more opportunity to discuss it in the next session when Carolina Tetlock is going to talk further about it.
Thank you. It is now Professor English's turn to address us and subsequently to introduce the second speaker. Is there any online connection with Professor English?
He fell asleep.
If not, I will take the. Here he is.
Now he's the
We can't hear you, Professor English.
Professor English, can you hear us?
Okay.
Okay. Then you can introduce Martina Dance and her topic.
Otherwise, I do it if we can't hear. No problem.
Okay, she will do it herself.
Yeah. Okay. Thank you, Professor Popovich, and thank you for the organizing committee for inviting me. I'm Martina Dans. I'm a PhD candidate at the University of Neuchâtel, currently doing a visiting research stay at Columbia in New York. And I'm going to talk about taxation of crypto assets in light of the provision of the OECD Model Convention. So, first of all, just to give you an introduction, we are witnessing huge technology advancements in the field of decentralized finance in the last decades, right? Nevertheless, there is a huge lack of legislative response everywhere in the globe. Okay, authorities, they can't keep the pace with everything we're witnessing in technology developments. Why? Well, of course, some of the main elements there is non-physical presence, as we traditionally see that. So there is no physical presence in all market jurisdiction. And of course, the decentralized nature, which is the main feature of DeFi, of all those businesses. As consequences from a tax standpoint, as main challenges, among others, we are seeing income characterization. It's a huge issue, as of course, localization issues. Just to give you a little bit of the technology background here, I'm going to start with cryptocurrencies, which are the most known form of crypto assets. Crypto assets is a catch-all term that defines all kinds of digital financial instruments that are based on cryptography and that are decentralized by nature. Particularly cryptocurrencies, they are financial assets that are used as means of payment, maybe as a store of value too, so for investment purposes, but they don't grant any kind of rights to their holder. So this allows us to distinguish this kind of tokens from the others we're seeing, like utility tokens, which on the other side, they grant digital access to a specific service or application that is developed by the issuer of the tokens, or investment tokens, which are more like traditional tradable assets, maybe giving rights to some income streams like dividends or similar to dividends and interest payments. We've heard a lot about non-fungible tokens, NFT, in this last 1 year. They are a peculiar form of token, okay, so a bit different from the ones we already saw. They are known to be unique and not interchangeable. That's why we call them non-fungible. Okay, so one NFT doesn't equal one other NFT, like in the case of Bitcoins, other cryptocurrencies. What is peculiar with NFTs, I think their main feature is actually the representation on the blockchain of a identifiable physical or digital assets. That's the main feature. As the example in the picture, you may have an NBA shot, a video that is tokenized, meaning represented on the blockchain, uploaded and put into an NFT, or maybe a digital work of art, but also physical assets. And there's going to be more complicated, of course, because we don't know which kind of rules we apply. Do we apply the digital services rules, or do we actually refer to the physical asset underlying that NFT? Not sure. So we keep it simple. We just stick to digital assets that are tokenized here. So as I said, the integrative function is the main one of NFTs, and that allows us to guarantee the ownership and authenticity of those underlying assets represented on the blockchain, of course, and ideally the secure and rapid transmission of those underlying assets. So we've discussed a lot about tokens, any kind of tokens we can have on the market. All those kind of crypto assets, they rely on an infrastructure which is called blockchain, so distributed ledger technology. It works like a database, like decentralized database, where all transactions are recorded chronologically and that are shared and updated constantly with a huge network of users. So in order to make sure, since it's decentralized, to make sure that those transactions are legit, we have to validate them, right? There are many ways in which we can do that. The first one, and the most known one, and discussed also, is mining, so proof of work. In this kind of validating mechanisms, we have a supply of computing power in order to validate transactions. So we can see in the pictures servers working to validate transactions in a huge mining farms. But we can also witness solo miners, meaning people with their own computer and server at home doing these validating mechanisms on themselves. So in this case, when we validate transaction, we receive as a reward new coins that are issued, or maybe transaction fees on the validated transaction. Mining shouldn't be confused with liquidity mining, even though the terms are quite similar. It's two very different operations. In liquidity mining, we have a supply of crypto assets for investment purposes, so we just lend our tokens to other investors, and then we receive a fraction of the income they realize on those borrowed tokens. Second way, most known way of validating transactions on the blockchain, it's staking, also known as proof of stake, which is more interesting compared to mining because of environmental issues. So you may have heard a huge merge of the Ethereum blockchain that recently happened. Well, Ethereum is a huge blockchain, okay, that issued Ether, which is a cryptocurrency. And they just switched from a proof of work system to a proof of stake validating mechanisms in order to, maybe made some economies in terms of environmental energy consumption, because it was a huge deal and so much debated. So in this case, the difference is that we are pledging a certain number of tokens we're having on a specific protocol to validate transactions. So the higher the upright, the better the chances we're selected as validators, because we have a greater interest in keeping that particular blockchain safe and legit. So moving on to the tax analysis, starting with mining activities. So to recall, validating mechanism by supply of computing power. Here, the income at stake is the reward of new tokens, new coins, and the transaction fees on the transaction validated. In this case, if we consider that income as a result of the validation work itself of the miner and the supply of computing power, but especially the validation work, we could see it as business profit according to Article 7. Otherwise, it's a bit stretched, I know, but if we look first of all, at mining farms, we could see that income as the product of that huge premises, huge mining farms. So maybe why not income from immovable property? Bit stretched, I know, but just in this situation, we could foresee it. If none of the above applies, we can always tax with Article 21, of course, and we'll see here the source of income and attributional taxing rights quite problematic. Why? Because if we apply Article 7, it means we need, in order to, having taxing rights in the source state, find a PE there. So a PE means a fixed place of business, maybe premises, personnel, or servers, or an agent PE. In particular, concerning server, we may have a server PE that is existent in the source state, even though maybe if we manage to actually say there is a server PE in the source state, an allocation key is not straightforward, right? So we don't know which server is currently operating on that specific transaction. It's very complicated. Anyway, at the end of the day, applying Article 7, taxation was going to be probably in the resident state of the minor, and maybe if we can manage to find a PE in the source state, it's going to be located there. I also put no agent PE because solo minors, meaning people, individuals, validated transactions are generally working on their own, so with no company backing them. And finally, Article 6, well, of course, taxation in that case would occur where the computers are installed. For liquidity mining, meaning the supply of tokens for investment purposes, meaning a loan, some kind of DeFi participatory loan, in that case, the income at stake is a fraction of the income realized by the borrower. Here, of course, according to us, depending on the lender's participation in the risk, so the liquidity provider, it could be dividends according to Article 10 or interest according to Article 11. In this case, taxation would occur in the recipient's resident state, of course, unless there is a permanent establishment in the source state, but quite difficult to establish. Here I put a small diagram I made just to show you the interaction between liquidity mining and staking that we're going to see in the next slide. You have the liquidity provider on the left side making a contribution to a liquidity pool, and then you have crypto traders that borrow those tokens in order to do some investments. And then the fraction of their income goes back to the liquidity pool and goes back to the first liquidity provider in the form of a token. With that specific token, we could foresee, for example, a staking mechanism on another crypto exchange or maybe on the wallet itself if it allows that, and then staking rewards going back to the liquidity provider. So we can see, the interaction between those two different mechanisms and how it can be very interesting for the liquidity provider at the end. Moving on to staking activities. As I said, validating mechanisms via pledging of tokens. Here, the reward is the same we're having with mining activities. However, I only see that there is a small difference compared to mining. In mining, you have the role of servers, the role of computers, which is huge. Here with staking activities, I don't see that. I just see that we're pledging tokens, and because of those tokens we pledged, we can validate transactions, and there is our work there that is deployed. In that case, I would apply business profits, Article 7. In any way, I wouldn't apply passive income provisions. So according to me and my professor, it shouldn't be passive income coming from staking activities. But of course, we can debate on that. Also, one more point about that. Yeah, it is a proper activity. Why? Because we can even delegate it. So staking activities, or well, at least staking power can be delegated to other people. So we're still owners of our tokens, but we can delegate the power of validating mechanisms to other people. So source of income and attributional taxing rights, if we apply Article 7, of course, we should ask ourselves, is there a permanent establishment in the form of servers PE? Yes, why not? But I think there is not a sufficient link in order to establish that, much weaker than compared to mining activities. So at the end of the day, taxation should occur where the recipient is located. Ownership of tokens, here it's very wide, meaning any persons that hold tokens for investment purposes, no matter the nature of the token. So here is any income deriving from that ownership, and it could take any form. It's very complicated, to establish a rule of thumb. So generally it could be business activity, of course, Article 7, but it could also be Article 10 or 11 if we're having some income streams that are similar to dividend or interest, meaning ownership rights or other kind of entitlements that go in that way. Or maybe you may have payments that recall royalties because there is a conferral of IP rights. Okay, especially in the case of NFTs, this is absolutely that's the case quite often. So application of Article 12. In case of application of Article 7, again, possible server PE, but we're not very satisfied with this solution. It's not enough. The localization of stakeholders is complicated. Allocating taxing rights is complicated, even if we find that there is a server PE. So at the end of the day, yes, it's always the resident state of the recipient of the income. But we'll see here, I put where the blockchain operates. It's actually the solution. I'm going to discuss it later. But yeah, if we apply this provision, it's going to be in the resident state. Idem for Article 12, 10, and 11, it's going to be taxed in the recipient's resident state, unless, of course, there is a permanent establishment. Last transaction, sale and trading activities of tokens. So it could be sale on the primary market, for example, an artist tokenizing his own digital or work of art or physical work of arts and selling them on a digital platform, or could be trade for more financial instruments on the secondary market, crypto exchanges. In that case, we're discussing about any kind of capital gain or income that derives from this sale or trade, but also conferral of IP rights. So in this case, of course, a huge distinction should be made according to whether it's a transfer of digital products for personal use and enjoyment. In that case, of course, we're witnessing an acquisition of data, and we should apply Article 7, so business profits, or capital gain, Article 13, while if it's a mere download of digital products, same nature, for the use of IP rights, then of course it would be royalties, so Article 12. So in this case, same mechanism with Article 7. Allocating taxing rights is impossible. I mean, not straightforward at all and not satisfying as a solution. So we end up always with the recipient's resident state. And for Article 12 or 13, recipient of the royalties in case we having royalties, or just the seller resident state if we having capital gain. So in conclusion, we can understand that the current OECD rules don't cover all these decentralized and digitalized activities. So these businesses, these individuals working on this kind of infrastructures, and we're having huge problems with qualification of the income and also the source of this income related to all kind of crypto assets. So yeah, of course, there is a need for a revision of, PE's concept first, absolutely, in order to encompass more those kind of decentralized businesses. We want to reach a more efficient taxing, rights distribution, and according to us, a solution would be to focus on all those market jurisdiction, meaning where the protocol or the digital platform or the crypto exchanges operate in order to be able to allocate better, taxing rights. So amendments are needed in this sense. Thank you for your attention.
Thank you, Martina. Let us connect with Professor English.
I solved the issue. Huh? Here's the up.
We can hear you.
Yes.
We can hear you.
That's good because I can hardly hear you now. But okay. Thank you very much for this presentation. I'm sorry I couldn't introduce it. I had some technical issues apparently. Welcome everybody. My name is Yariv Brauner, University of Münster, Germany. I'm very happy to chair this panel together with my colleague Professor Popov. Of course, obviously sharing it online is a challenge, as we could see. But anyways, that was really an interesting presentation that raised a lot of intriguing issues. Personally, I say Article 6, the property seems very far-fetched to me, even when it comes to the traditional approval work approach. And I also wonder whether we really need to discuss much the situations where tokens basically just replicate instruments that exist already in the classical world. So security tokens in particular would replicate traditional token equity instruments. So it's obvious to me that then Article 10 or 11 would apply. But I guess I really feel that the new proof of stake concept, as well as NFTs, raise important issues that are less clear, and I think we probably should focus our debate on this. I'd like to invite the panelists to give their comments, and being aware of time, I think we might have time for one or two questions from the audience, which I would like to ask my co-chair, Professor Popov, then to panel, because it's a bit difficult from here to see who's showing up. So if I could ask the panelists to speak first, please.
Well, small intervention. My name is Popovich rather than Popov. Okay. Not at all. That's fine.
So may I? Okay, so thank you very much, Martina, for this wonderful presentation. I really enjoyed reading your paper. I have one comment and one question for you. So the comment is just sharing with you and the audience that very recently in Spain we have seen published a tax ruling by the tax authorities regarding income from staking activities, in which they take exactly the opposite way that you lay down in your paper, which, don't take me wrong, doesn't mean that you're wrong. On the other hand, what I think is that you are totally right, because your paper raises the issue that the income characterization of these activities will trigger real problems. And I think this is a first example, at least I have to give it to you. So if you want, I can share with you that tax ruling. Basically, what the Spanish tax authorities say is that the income from staking activities should be characterized as interest income.
Interest income.
Yeah, income as a consideration for lending capital.
Yeah.
Whether they are right or not, I leave it for you, that you have studied a lot about this. My question is regarding income from mining activities. So in your paper, you define mining activities, if I understood well, as a mix of providing computer power plus validation activity.
Yes.
And let's leave aside for one moment, because I don't feel very comfortable with Article 6 in this, but then what you say is, okay, let's see if it's Article 7 or Article 21 that should apply to this type of income. And then you say, if I understood correctly, please correct me if I'm wrong, well, if the focus is on the provision of computer power, it would be more of a passive nature of the income. So probably it would be Article 21. Whereas if the focus is on the validation activity, probably we should regard it as active income, and we should go to Article 7. But I didn't see, let's say, a final opinion on it. So, and please, I have no knowledge at all, apart from what I read from your paper. But is this validation activity an activity that really needs special knowledge by the miner? I'm not a miner myself. I haven't seen these miners acting. Does it require, let's say, a true involvement on it? Do you really need to devote time to this validation activity? Perhaps that would be some clues to address the question. And the question is, do you feel more comfortable with active income, so Article 7, or passive income, Article 21?
Absolutely.
Thank you.
So going back to your first remark on the Spanish ruling, I really don't see how it could be passive income from, staking activities, because there is a real activity that is deployed so much that it can actually be delegated, as I said. So I really don't see why you should consider them as interest payments, especially because you have liquidity mining that fills out that definition, like there you have tokens that are borrowed by investors, and then you have incomes that goes back to the liquidity provider. So there I would understand, passive income streams, but not in the case of staking. But I would be interested in reading, the ruling. And for your second question, I know, well, it's leaving aside Article 6, which is, yeah, I know, quite stretched, but going back to Article 7 or 21, it's difficult to take a position. I understand that active involvement of the miner is not properly there. We could discuss, like, yes, there is a setup to put in place, like downloading some software, maybe having a little bit of knowledge of what we're doing. So we had to do some studies, before becoming a miner. So we could discuss in that way. But yes, at the end of the day, there could be a debate on that point, of course, and we may end up on Article 21. I couldn't take a strong position on that. I say, yeah, we try with Article 7, and if really cannot prove that there is an involvement, there is a real activity that is deployed, then we fall into Article 21. There is Vikram with my question.
There is an idea that since we have Dr. Turina's paper, which is closely connected with this one, to proceed with the presentation by Alessandro Turina, and then we will have the joint comments by the panelists and you in the audience. In that way, we will somehow manage these delays we are already enjoying. So, if Dr. English agrees with me, I think that we could now give the floor to Dr. Alessandro Turina from IBFD, who prepared the paper on how have the exchange of information data protection standard evolve, especially in the cryptos domain. And then we will go further. Dr. Turina, please.
For the introduction, and well, I would like to thank it's not just a sort of complying with the usual courtesy, but I've been lucky enough to call all of the founders of this cutting edge group, which to me is like the biggest change. I mean, this is, I think, perhaps even the most interesting event really for this year, to call them colleagues. And in the past, because we people then move ahead, but and still call them friends. So it's a huge privilege, and a special word of thanks to our most gracious host, Professor Kostic, and for the wonderful hospitality, and in particular also, as usual, I would like to thank him for his introduction this morning, because he gave me something to think about the history, very learned as usual on the history of his country and the city. And I think, of course, maybe it may seem like first we talked about mobility, now first influencers. So again, mobility, crypto assets, perhaps, how do they fit? I think there's a red thread. So if we are in Belgrade version 45, if I'm not mistaken, this, I think it's a telltale that as the, let's say, international relations at age goes, geography is destiny, no? And I think the red thread of this day is basically that we are trying to cope, if this is true still, we're trying to cope with a world that is trying to get rid of geography in a way. And so we will see it, I think, also with regard to this crypto assets. My perspective is complementary to the one by Mrs. Dunn, whose paper I found truly enlightening, as I'm not, let's say, I'm a sort of layman when it comes to cryptocurrencies. It's my first venture into this field. I've worked a bit in general in exchange of information, and what we may refer to as enforcement jurisdiction. So the perspective of this paper will be primarily enforcement jurisdiction with regard to crypto assets. What do we mean by enforcement jurisdiction? Just to make sure we're all on the same page, it needs to be juxtaposed to substantive jurisdiction in the sense that substantive jurisdiction has to do with the question of the power of a country to impose tax on a subject matter of exaction. So essentially the question, who gets to tax what, who has the right to tax, let's say, something. And of course, it presupposes what I think Martina did in a very innovative and thoughtful way. It presupposes some sort of categorization since we have a sort of let's say schedular system of sorts. I mean, this type of logic is governed by still a sort of schedular approach. My concern, my angle is a different one, and it should really come second logically in the various, let's say, if you think about the process, the pipeline of taxation, and it has to do with essentially the power of the country to actually compel collection of tax over which it has jurisdiction. And of course, in order to collect, you also need to know. No, you cannot collect what you don't know it exists. So typically, first you would have to fix your claims when it comes to substantive jurisdiction, and after this, get engaged with enforcement jurisdiction. In the area of crypto assets, if I'm not mistaken, it seems that the reversed approach has been undertaken. So there's a relatively developed framework, although not final with regard to enforcement, but very little when it comes to substantive matters. So what I would like to do, I mean, after having defined a little bit the scope of analysis, is to adopt somehow of a UFO approach. So update, focus, and outlook may be familiar to you if you attend IFA events in particular. I think it's a common template. And so what is perhaps the two items that are of the greatest topical relevance are the sort of tale of two cities. So Paris, understood as the site of the OECD, and Brussels as the site of European institutions, because they've been invested with a lot of work in this specific area of enforcement jurisdiction on crypto assets. So let's start with essentially the OECD perspective. But first, I think it's appropriate to, and once again we go to this red thread of let's say a post-geographic world with the inherent challenges which I think make dealing with enforcement tax jurisdiction particularly arduous with regard to crypto assets. I would say there are challenges on almost all levels, subjective. So essentially you have to deal with pseudo-anonymity, which is not anonymity. And so it raises, let's say, questions from both sides, so to say. And linked to the subjective dimension, I would say also the instrumental one, because when it comes to other categories of assets, at the end of the day, I think also relying on what Martina introduced, I think the main question would really revolve around the ownership of these assets. So typically, with regard to other financial assets, you can rely on intermediaries. It's something quite established. Here you have a complete disintermediation. We talk about decentralized finance, not by chance. And then you have the objective perspective, so dematerialization. I mean, what are these tokens? At the end of the day, they're lines of code and something to which you access through a public code and a private code. And then, of course, locational, because we are dealing with deterritorialization. Of course, it's somehow of a charged term. Maybe I'm using it a bit, let's say, improperly here, but I think it's clear that if in general income lacks geographical properties, in particular this type of income, however you may define it, you may categorize it, really exacerbates with this deterritorialization trend. But this being said, in terms of very big picture, this is essentially what, just to give you a little bit of a glimpse of what has been moving around. So the OECD has been quite an early mover already. Last spring, it came out with essentially a sort of modular complement to the existing common reporting standard called the Crypto Asset Reforming Framework. This is just the first block in the sense that essentially it's a set of model rules with a commentary. There has been a public consultation which received a lot of inputs from the industry primarily. What is basically also in the pipeline will be, once the CARF rules are defined, a sort of a competent authority agreement model, so the one that will essentially enable exchange of information. And then also very important, of course, in this case, the whole issue of IT platform, so how to make this thing actually work. And I don't think I have the time to really delve, let's say, too much into the specifics of this proposal, but I would say it boils down essentially to trying to understand what does ownership of these assets entails. That's, I think, the question that is not really formulated, but that is sort of inherent to the whole effort. When it comes to the material scope, it's quite easy because they have a sort of catch-all approach. So anything that is not a closed-loop crypto asset, so something you can use maybe just within a very specific segment, or which is not a central bank digital currency, which is also a very interesting development I will not be able to address, unfortunately, is essentially included in the scope of this reporting. And also very broad is the definition of what is reporting crypto asset service providers. This would equate essentially what in the CRS jargon are essentially these reporting intermediaries. So an individual or entity as a business, so they have to do it, let's say, provides a service between exchange transaction with a counterparty, or as an intermediary to such an exchange transaction, or by making available a trading platform. So essentially all the possible ways in which you can be involved in this type of ownership transfer are covered. The type of transactions that are covered are also, I would say, sort of exhaust, let's say, the possible, when it comes at least to the transfer of ownership, which once again is the underlying main rationale of the proposal. So exchanges between crypto assets and fiat currencies, so sort of these Chinese walls between two types of, let's say, currencies, exchange between one or more form of crypto assets, so from NFT to, let's say, e-monies, or reportable retail payment transactions, so when you use it essentially to purchase something, and transfer of crypto assets, which is perhaps the most obvious situation, where you transfer to another owner, or maybe if you have more than one wallet, so to say, which is a sort of digital place where you store, not really, if I understand correctly, not really the actual currencies, but rather the codes to these currencies, because the currencies themselves, well, actually entail, well, it's very hard to separate the code from the currencies, essentially. And this will be made available through digital due diligence requirements that sort of mimic what you already see with regard to CRS. So self-certification, which is what you have right now with CRS, plus a sort of reasonable test based primarily on anti-money laundering, know your customer rules. I think while the first leg makes sense because it sort of equalizes the two realms, this latter sort of double check is where I think the devil is in the details. And here, unfortunately, the details are not clear at all. Not only because, of course, these FATF recommendations are not with regard at least to crypto, if I understand correctly, well, in general, their legal status is disputable, but they're not binding, but also because we will see that, for instance, with regard to the EU perspective, I mean, the EU being a very large market, something happened very recently that may sort of revolutionize the landscape. Then there are other side issues that are also quite important. For instance, can we rely on information that has been achieved through and collected by other persons who are not intermediaries? Or what are the implications in case of I think in the FATCA jargon there was this recalcitrant account owners. So what do you do with recalcitrant e-money owners, essentially? Do you stop executing their orders? That's also not very clear. And then, as I said, it's a tale of two cities. So the view from Brussels is that exactly yesterday, I think that shows the soft power of this research network, because they had it, they sort of encourage the reaching of an agreement at the council level on this markets in crypto assets proposal, which essentially will entail a regulation, so something that will be directly applicable across the EU, and also an amendment of an existing directive of breaches of EU law, so a little bit broad, but essentially this will be, if you're familiar with the EU financial regulation framework, the equivalent of the MiFID, but applied also to crypto assets, essentially. And you can see, I think the slides will be shared. So the proposal with all the various of essentially reports and impact assessment studies is available at this link. Really, I mean, some sort of breaking news. And the issue that even though, of course, this is not primarily a tax-related measure, it creates categories, it creates definitions that I guess would be hard to do without, or would have to be reconciled with the reporting framework. And perhaps it's not a coincidence that the equivalent of the CARF from an EU perspective, which most likely in the long term may simply translate into a transposition of the CARF into the EU framework, exactly what happened with TRS, and I think it was DAC 3, if I'm not mistaken, or DAC 2 maybe. So essentially, you transpose a global standard into the EU order. I think that was the original idea, but I think this will be something more difficult to achieve because essentially can you hear me? Yes. The OECD CARF essentially does without this common regulatory framework. Is a little bit up, and it starts from the roof, so to say. The EU has been as not being a first mover in this regard, so perhaps they also wanted to wait for the outcome of this MiCA work. But now the EU will be a little bit behind with regard to reporting, but more advanced with regard to regulation. And the question is, would this new regulatory framework, which concretized and whose outcome was not so obvious, because it's true that was adopted on a different legal basis from the one with which we are familiar for taxes, so it didn't require really unanimity. But still, there were a lot of diverging views, let's say, in this matter, and eventually it came across. It needs to go through the parliament, but that should be quite, not really a rocky journey. So exciting times, a few selected issues. What does this entail for certain fundamental rights, primarily of taxpayers, but to some extent also intermediaries? And I would argue that data protection is the most obvious one, because as I said, this let's say, crypto assets rely not really on full-fledged anonymity, but rather on pseudo-anonymity. So you're entitled to keep your pseudonym. It's like a little bit your nom de plume, but at the end of the day, they will find out who you are. So it's at the same time, we will see there are certain peculiarities associated with the coding aspect of it that may make this let's say, this veil difficult to penetrate, to unveil. And it's interesting because actually this very proposal of the MiCA regulation, which was approved yesterday, attracted the attention of the European Supervisor on Data Protection. So basically they found that it contained quite a few issues. And one of the, let's say, main points was that it was not clear who would be responsible for managing, let's say, this personal data protection. In this regard, I think it's very interesting also the development we have observed at the EU Court of Justice level with regard to GDPR and taxes. At the end of the day, it seems that the GDPR is not really bulletproof when it comes to, let's say, requests by tax authorities. In principle, yes. In principle, tax administrations can ask this information. There are, however, two, let's say, red lines not to cross, which in my mind, if my understanding is correct, appear very problematic when referred to crypto assets. First one is that it needs to be clear what is the specific purpose of the collection of the information. And now here we don't have a clear idea of the categories. So we know what we're going to ask, but we don't really know whether it's going to be useful because we don't know which kind of tax treatment we should, let's say, we should apply to the various let's say, constellations of possible transactions. The second item that I think is quite problematic is that one of the recommendations that can be derived from this case is that the holding of the data should not exceed the duration strictly necessary to achieve the objective. Now, if my understanding is correct, the whole cryptocurrency relies on blockchain, and blockchain is something where you cannot really delete what is, it goes line by line, it's not possible to go backwards. So blockchain, in other words, does not go hand in hand to the right to oblivion. So essentially, this I think is a very sensitive point that may come back in the future. And we said that the perspective is one that is concerned with enforcement. Yes. Just a couple of minutes and I will conclude. The inherent hurdle with tax collection is that, of course, there are different tax qualifications. We mentioned the Spanish example. We mentioned, I think, creative input by Martín. I will get in touch with international organizations also. and it's very easy to manipulate. And I think there are different ways in which you can hold the crypto assets. So you have exchanges, which is the blue one, so the safest ones. Essentially, it's not really a direct holding of the crypto assets. You simply have a sort of account with intermediary and sort of debit credit relationship. Then custodial wallets, where essentially the intermediary has access also to the private key, in fact, so something can be done. But then you have cold wallets and non-custodial wallets that in different forms basically entail that even though the owner may be only pseudo-anonymous, so not completely anonymous, but still is in the sole, let's say the material possession is in her sole prerogatives. Cold wallets, that should give you an idea, actually work as a sort of USB sticks where you carry the codes. So how can you collect this? Either by decrypting the information, so using sort of the new Turings, or the new Nashes getting hired by tax authorities to decode this, or otherwise by relying on the use of force. So my impression is that essentially the whole crypto asset subject matter is problematic from the point of view of balancing the prerogatives of the state, the fiscal interest, we may say, and the safeguard of fundamental rights, essentially because the exercise of enforcement jurisdiction is simply much more complex, uncomparably much more complex compared to other situations. And so we need to think about new categories, and perhaps well, I leave some open questions here just to conclude and quote again, I think our colleague, Professor Kostic, he mentioned about hunters gators meeting farmers here. Yesterday I was at a conference on the digitalization of public administrations in Naples, and one of the speakers from the public administration said that, yes, we are a bit the Neanderthals of the public administration. And one of the peculiarity of the Neanderthals, well, first, they came a bit earlier than Homo sapiens, but also they had a little bit of a more aggressive streak. And so my concern is that hopefully tax administration will not behave as Neanderthals vis-a-vis, so let's say with very little knowledge and let's say high levels of aggression. Thank you, and sorry for taking more time.
Thank you, Alessandro. Now, let us first hear from our panelists.
Thank you very much, Alessandro, for your presentation again. So I have a piece of info to share again with the audience. Again, I have to refer to my country, but I think this is also about sharing new developments. And then from that, I will raise some questions for you, Alessandro. So in Spain, basically, we are expecting, as soon as for next year, three new reporting obligations regarding cryptocurrencies. First one would be by the wallet service providers. They will have to report the cryptocurrencies they have under custody, and they will have to identify the owners or the UBOs, so to speak. Then the second annual reporting obligation will be for I will say it, for cryptocurrency service exchange providers. And then there's another one, which will be for the taxpayers, who will have to report all cryptocurrencies they hold in wallets outside Spain. Understanding by wallets outside Spain, those who are not reported by the Spanish wallet service providers. And then my question is, after your research and study of this, are these aligned with the preparatory works of the OECD and the EU on the matter? Your gut feeling, I don't expect, of course, a very developed answer, but your gut feeling is that this is in the good direction? You think it will be easy to enforce?
Thank you very much for the question. And I noticed that Spain is a sort of laboratory for a lot of innovations in this area. But the point, I guess, so just two comments, one on the method and one on the merit, let's say, of the matter. On the method, what I think it's good to start getting things on the move, but there are some extra costs associated with being early movers here, especially because this sort of broader regulatory framework, not only on tax but in general on what are the rules of the games of this from a financial regulation perspective, and we're not really clear. I would say they're still not really clear because we don't have the regulation out yet. But until yesterday, it was a big question mark. So perhaps starting to go in a certain direction when things may take a different evolution may exacerbate the problem, because especially in the perspective of let's say intermediaries, they have to maybe set up a system of reporting and then maybe the rules of the game change. That's something we saw, I think, with CRS. Of course, there was reporting before CRS, but then each intermediary had to adapt their systems to the new standard. So that would be, let's say, my question. With regard to the method, with regard to the merit, the issue that I see is like a two-pronged approach. So you rely primarily on intermediaries, and then you ask for a sort of self-reporting by resident. And of course, this is very problematic from a, let's say, compliance viewpoint. I think there are studies that demonstrate if there is no sort of fact-checking from the other side, I think compliance goes down by like 50% or so, which seems to me quite optimistic, but maybe because of my original, let's say, affiliation. But still, so unless you have a robust mechanism for verifying what, let's say, taxpayers self-report, it seems to me more like a sort of signaling type of thing rather than something that will really have a bite. But it's very interesting. I was not aware of these developments, let's say, specific that they were so concrete, and so it's thank you for this contribution.
Thank you very much. They are draft regulations anyway, but I think I agree with your viewpoint.
After having heard Dr. Turina's presentation, I must admit that I remain impressed by the enormity of the task tax administrations will have to face with. There are around 200 states and jurisdictions in the world, and I guess that one may find quite a number of them that are not ready to comply with the proposed OECD crypto asset reporting framework. You may tell me that BEPS was quite a success, but I bear in mind that Russian aggression on Ukraine has pushed the world into a phase which is very different from the 2013 cooperative BEPS mood. Subversion rather than cooperation, denial rather than exchange of tax information could become new features of the international landscape in the years to come. This may not have a direct impact on OECD and EU member states, because they will continue to behave in good faith, at least as a rule. But the existence of safe havens for tax evaders in the states that are otherwise exposed to sanctions like Russia or Belarus, and perhaps in some others, could undermine certain cooperation principles advocated by OECD. I would appreciate if Alessandro and other participants could comment on these, to an extent, my pessimistic predictions.
So, thank you very much, Professor Polish. I don't have much to say because I simply wholeheartedly and definitely agree with what you just said. Perhaps just bring a little bit of a concrete example of, let's say, new rogue countries when it comes to financial regulation, particularly with the area of crypto. I can bring the example of Iran. Iran is, of course, being on sanctions for several decades. It's also very troubled economically, and so at the same time, it's a population. I think it's perhaps Professor Brauner may confirm, but I think it's one of, if not the leading, among the leading population when it comes to brain drain. So very good, let's say, educated base, very young population. So cryptocurrencies were like welcomed as perhaps the only way where you could put your savings, or at least and the regulations are basically kept at a very minimalistic level. So I understand that there is indeed someone using already Iran, just to make an example I'm familiar with, as a sort of stepping stone for also with regard to, but now it's already it's still quite unclear that the regulatory framework, but in the future, if we were to converge maybe part of the world, towards a sort of common framework, still there will be patches, and it will be much more difficult to address them, I think, because of the very nature of the instrument, in this case of crypto assets, which are simply lines of codes once again. So something very difficult to monitor and control.
Thank you. Let us give the floor to Professor English.